Hey, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And since we spoke last week, we've had a pretty substantial shift in regards to the overall sentiment for the US equity markets, the US bond markets. Largely on the back of the CPI print last week, which showed that inflation was stickier than expected, that the fight on inflation has effectively stalled, and then had a pretty monumental shift with regards to expectations for rate cuts this year. Throughout this entire year, we have predominantly priced in three rate cuts starting in June. Based on the CPI print last week, that has shifted, first of all, out to September for the first rate cut. And right now, the bond markets are pricing in only two cuts for the rest of the year. And that's, from my perspective, a pretty big shift in terms of expectations, even though I would say that a lot of the underlying data was already pointing in this specific direction. The 10-year yields were already at 4.3 prior to the CPI print, leading us to shift directions, but it didn't quite open the door enough for a pretty substantial shift, and that's exactly what we've seen. And then over the weekend, we obviously had some escalations in the war in the Middle East, and that has had overall a substantial change in terms of the tone in equities. So if you look at the S&P 500, as of yesterday's close, we did manage to close below the 50-day moving average. We have not seen that since November of last year, which has been a pretty strong upward trend since then. Last week, we started to notice that the momentum was starting to slow down here. And this week, we broke below the 50-day moving average. So those are some of the pretty substantial shifts that I would say with regards to the overall change in tone and direction of the markets. We see it on both the S&P 500 and the NASDAQ 100. Right now, momentum is just shy of being negative here on the NASDAQ 100. It is just shy of being negative on the S&P 500. So both of these potentially at risk of further pullback. And if we look at IWM, this had already broken last week on the back of the CPI print, and as of yesterday, continues to move here to the downside. So small caps leading the move here to the downside, with S&P and NASDAQ now following through as of yesterday. We also saw the same thing out of the equal weight S&P 500 index, RSP. Last week started to close below that 50-day moving average, and as of yesterday, we continue to follow through a close below those levels. So, if you look at the major indices across the boards, large cap, small cap, equal weight, market cap weighted, no matter how you slice and dice the indices, they have all confirmed this shift in terms of directional view for the US equity markets. So, we've been talking about this uptrend for what feels like an eternity. And this is the first time where that trend has clearly changed from bullish to now, at the very least, neutral and potentially bearish. If we look at this is a chart of growth versus value, and over the long run, growth continues to outperform value. But over the last few, about 2 months or so, value has actually outperformed growth, which is generally speaking a healthy sign of the market. But over the past few trading sessions, we have continued to see growth outperform value. We did see a reversal of this yesterday, so we'll continue to monitor this as to whether or not growth starts to outperform value going forward. The commodities ETF, GSG, did make a crack at the $23 high as of Friday last week. It didn't manage to close back above it, even though intraday got above it. Yesterday, we still closed below that $23 level. But overall, my expectation is that there's still potential upside for commodities at the moment, especially on the back of safe haven buying that we see in terms of gold. Oil seems to hit a bit of a cap here with, in that $85, $86 level, and we'll take a look at some charts here and there. But gold and silver is largely what has driven this substantial upside with oil, even though oil at the moment has stalled a little bit with regards to that move here to the upside. As we shift over to bonds, HYG, this is one of the signals that we've been looking for with regards to kind of a risk on, risk off market. So however you want to draw your lines here, the HYG high yield bonds have had a pretty substantial move here to the upside since October, and then spent quite a bit of time consolidating after that big move, which is generally healthy and generally necessary. And then what we got at the beginning of March was what looked like a bit of a breakout here. And that was, at the time, a risk-on signal that the bond market is signaling that from a credit perspective, things look okay, continuing to rally. But that has so far turned out to be a bit of a false breakout, and we're kind of trading back into the range. And that puts us back into a much more neutral and potentially risk-off signal that we're getting from bond at the moment. VIX yesterday closed at a recent all-time high of 19.23. This is a level that we haven't seen since October of last year. So, this is really speaking to a fair amount of fear and put buying from the overall markets at the moment. And it's difficult to navigate at the moment with regards to this type of volatility. But we're definitely paying attention to changes in volatility, because changes in volatility doesn't necessarily mean a change in direction for the overall market. You can still have an uptrend that's just more volatile, but a 19 handle on the VIX is a pretty substantial shift considering we were trading at a 13 handle just 2 weeks ago. So a very substantial shift in terms of changes in implied volatility, or what traders expect volatility to look like over the next 30 days. And we are getting to some extreme levels here, which certainly would favor options selling. So selling covered calls, selling straddles and strangles, iron condors, those types of strategies will generate an incredibly higher amount of premium relative to what we were getting just a couple of weeks ago. The 10-year yield did climb again yesterday to 4.6%. And this really reflects the bond market's not quite done with regards to expectations for rate cuts, meaning right now the market is pricing in 2 rate cuts. Can that change to maybe 1 rate cut or maybe no cuts this year? The way that the bond markets are continuing to price higher yields puts more pressure on those changes in terms of a more hawkish tone from the dovish tone that we've seen from the Fed over the past couple of months. And what we've seen is that despite the fact that the Fed has taken a more dovish tone, bond yields continue to rise. That means the bond market is effectively not buying what Chairman Powell is trying to sell at the moment. And effectively saying that there's a possibility that this could get back into the 5% range with regards to 10-year yields. And that obviously would have ramifications on valuations for equities. Certain sectors certainly will have ramifications on capital expenditure and investments when interest rates remain high. Those are some of the things that are concerning to us as we look at these types of charts. TLT broke below that $91 support level. This leads me to believe that there's further downside potentially down to that $81 level here for TLT. This really speaks to that potential for yields to continue to rise into that 5% range for the 10-year yields. The dollar index has broken out above 105. It broke out above 105. Our upside target here is now 107 on the US dollar. At the moment, prior to that breakout, our thesis was that the dollar was kind of range bound between around 102.50 and 105. We were seeing this kind of range bound action. This was our expectations, but instead what we got here last week on the back of that surprise CPI print is the fact that the dollar has now broken out above this 105 level. And this really puts us towards 107 on the US dollar at the moment. Gold continues to make intraday highs and new all-time highs. We're now trading at 2180, 2383, which was the big breakout from 2150. It's now broken out to 2450. My hunch is that despite the fact that gold looks short-term overbought, there's still further potential upside for gold in this kind of environment that we're in. There's certainly still demand for havens like gold contracts at the moment. Oil, we have seen oil retreat a bit, which is interesting, especially given the conflict in the Middle East. To see oil continue to retreat really speaks to the fact that supply remains quite robust. That despite the fact that we have these concerns in terms of escalations of war in the Middle East, oil actually still continues to decline. For me, that leads me to believe that we are potentially at a temporary double top here for oil, and we can see perhaps more of a neutral oil movement going forward from here, as opposed to this uptrend continuing into that $90 range. This double top here at 88 could very well, at the short term, be a bit of a temporary top. That's going to have an effect on energy stocks. Energy, obviously, one of the best performing sectors over the past couple of months. My expectation is that outperformance is likely going to see some underperformance if oil starts to correct or trade sideways from here. And then looking at the individual sectors, technology broke below that 50-day moving average, but from a relative perspective remains fairly strong here, both technology and discretionary. From a relative perspective, looks fairly strong. Consumer discretionary did lose a little bit more strength here yesterday. These are some of the concerns that I do have with the overall market, is the fact that technology and discretionary, two of the strongest sectors that have been leading the markets higher, are starting to show some weakness here. That's not particularly strong to have that show up. Communications at the moment remains one of the strongest sectors, as you can still holding the 50-day moving average. We'll see if that holds today, but relative strength here is actually incredibly strong. It's outperforming the S&P 500 at the moment. Financials on the back of JPM's print yesterday. Last week. Showing some weakness here. On the flip side, you have Goldman reporting strong earnings yesterday. So financials still showing a fair amount of leadership, but losing some of that leadership as the back of the JPM earnings. And we do have bank earnings still coming up, especially in regional bank, which I think are going to have a challenging time this particular quarter. So XLF, certainly one of the sectors that are at risk, in my opinion. Looking at healthcare, this is one of the weakest sectors at the moment. Healthcare broke below that 50-day moving average a couple of weeks ago. We talked about it back then, and as you can see, since then, it has continued to fall from those levels. The underperformance is still there. First initial targets around 137. If we break below 137, this can have a bit more to fall here into the low 130s. As you can see, the underperformance relative to the S&P 500 is clear. Momentum has been negative for quite a couple of weeks now. So this isn't particularly boding well for healthcare. Materials still hanging in there, still hanging in above the 50-day moving average. As you can see, relative performance is actually still decent. You have the momentum that is slowing down, but still positive at the moment. So this is a potential buying opportunity for those of you that are looking for long opportunities in terms of materials. You see the same thing in terms of industrials, holding on to that 50-day moving average. Relative performance still remains quite strong. Momentum, even though slowing down, is still positive. These are the types of sectors that if you're looking for buying opportunities, these are the ones that you would want to start in. Real estate continues to fall apart here, especially as higher interest rates. This is a sector that will likely continue to underperform in a higher interest rate environment, breaking below that $37 support. This is not a particularly strong sign for real estate. I think that there's further downside in real estate. Energy, we talked about the fact that we've got that double top in oil prices. I think that likely will be a double top in terms of energy stocks as well. I think that there's potentially some downside here in the short run for energy stocks on the back of the fact that oil prices have kind of stalled, despite the fact that we've seen um, an escalation in the Middle East. Utilities, slight outperformance here, not enough in my opinion to write home about. And then home builders, especially in a higher interest rate environment, home builders will tend to struggle here. We broke below the 50-day moving average, some underperformance creeping in, but as you can see, momentum is just about to turn negative here. This is one where I do think we are at risk of further pullback here for home builders. Same thing for semiconductors. We did break below the 50-day moving average on the SOX index, or the semiconductors ETF SOXX. Relative performance is okay, not poor, but as you can see, momentum just about to turn negative here as well. So this is one on watch for further downside. So if you're invested in NVIDIA, AMD, Intel, those types of names, those are the ones that are at risk of further pullback here. Okay, with that, a few other charts worth paying attention to right now. KWEB, the Chinese internet ETF, underperforming. We've been talking about whether or not the Chinese internet ETFs are going to start taking off here. Our internet's actually going to start taking off here. So far, this double top at 27.5 is holding. For me, that leads me to believe that there's still further potential downside here in KWEB. On the flip side, India, INDA, the ETF that tracks the India ETF, recently posted a double top here at 52.5, but still, in my opinion, potential for outperformance here. So, if you look at China versus India, between the two, certainly India looks far more strong in terms of the chart. Regional bank ETF KRE, just trading above this $46 support level here. But if you look at the relative performance, incredibly poor. And if you look at the relative performance, you see that it actually started to break below recent support here. Momentum is negative. This leads me to believe that this $46 support level is likely going to break. And there's some further downside here in KRE. And then looking at some ideas, let's look at Citigroup. For those of you that like the banks, Citigroup has been outperforming the S&P 500 by quite a bit. Recently pulled back, and as you can see, these types of pullbacks become buying opportunities. So this is really one where we're looking at, if you're looking for a trend following buying opportunity, Citigroup fits the bill. Still continuing to outperform the S&P 500. Momentum, even though slowing down, is still positive. So these are all the things that you typically look for if you believe in the overall bullish thesis and looking for a good timing or a good risk to reward for an entry. Citigroup fits the bill for that. Disney is another one that we're paying attention to here right now. Outperforming the S&P 500, recently kind of gapped higher here and continued to move higher from here, but recently pulled back to kind of that major support level around 112, 113. So if you're looking for a strong risk to reward, this is a good entry where you're risking very little to potentially make significantly more than that on an entry, because it continues to outperform and momentum, even though slowing down, remains positive. You see the same thing here for FedEx. A recent pullback here to the gap level here. We gapped higher on earnings, pulled back to this gap level, so it's filling that gap. So this is another where the risk to reward ratio looks fairly strong if you believe in the thesis. Outperforming the S&P 500, pullbacks, momentum remaining positive, potential for further upside or continuation of this bullish trend. And then looking at some counter trend ideas, meaning stocks that are either extremely have sold off either extremely a lot or overbought extremely and are at risk of reversal here. So Dell recently gapped higher from 95 to 125. But what you can see is it made higher highs in price. That was no longer confirmed by momentum here. The relative performance here after the breakout here or the gap higher has not been there. So this is one that, is at potential risk of pulling back and refilling this gap here down to 95. You see the same thing here in IBM. You got a gap higher here. And ever since that gap higher, the stock has underperformed. So even though it hasn't broken this support level around 180 or so, there's my hunch is that it will likely break that. You have first gap here around this 173, and you have another gap here around 165. Those are kind of the two downside targets here for IBM, especially if you notice that after it broke out, it's underperformed. And recently, over the past couple of days, that momentum has turned negative on IBM. On the flip side, Nike is one that I like. Recently severely oversold down to this $88 support level here. Revisit that level, so far bouncing higher. At the very least, we would target to kind of fill this gap here around 100, but potentially even more beyond that if we can get back to 100 for Nike. And then lastly, AstraZeneca. AstraZeneca recently kind of broke out above this $69 level here, after what has been a long kind of bottoming formation that we continue to see, and we're looking for that continuation higher here on AstraZeneca for a potential outperformance. And one last chart to take a look at, Ferrari. This is a stock that trades at a very rich valuation, 50 times forward earnings. Notice how it's kind of looking like a bit of a head and shoulders formation here. It hasn't broken the 410 support level, that neckline. But as you can see, ever since that head and shoulders formation has started, it has underperformed the S&P 500. And as you can see, momentum is just about to turn negative here. So this is one that could potentially be just on the verge of breaking that support level. And the gap fill here is in the 355 level area, which gives you a very substantial move here to the downside for names like Ferrari. So those are some of the charts that I think are worth paying attention to, in addition to kind of the macro view here, which obviously has changed quite a bit over the past week or so. We'll continue to update you next week on kind of how things develop, but that's where the charts stand at the moment. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.